All right, hey, good afternoon, everyone, and let's just jump right into what the markets did today and talk about kind of what it means in a bigger context. This is a weekly chart of beans. I'm going to come back to that here after we look at the daily because it doesn't look great on the daily, right? We have a big outside day down, double close key reversal into the close. They just started, or traders just pressed to the downside. I want to drop down to a 60-minute chart here so you can see what beans did today. We had a big, nice reversal after the report. We came up, and this is 11 p.m. This is midnight right here, and every hour after midnight, it was met with selling. Just a consistent series of lower lows, lower highs, all the way right into the close. So you look at something like that, and you think, "Oh my gosh, this is terrible." Well, markets don't move in straight lines. They almost always bounce, right? Because even the up moves are met with some nice pullbacks that were nice buying opportunities. And beans just never really provided anything like that today. So if you think about it, you think, oh my gosh, we have to be going lower because beans died. Well, on a single day basis, yes, that's exactly what it looks like. And it also looks like we're below our hedge line and we should just be heading lower. So if we put our cloud on top, here's what beans look like, right? It's not really that bad. Really what we want to see is we want to see these lows right here at 1333, which would be the low from August 23rd and the low from Wednesday. We want to see those two hold. And if you look at this from a Fibonacci perspective, and we're going to do that on the weekly chart as well, because I think it helps to give some context on why we still think this is corrective and why we think today doesn't really matter. The first thing is this Fibonacci retracement. We're holding the 61.8. We have yet to break it. In fact, we had a nice reversal off of it on Wednesday, and we still have done nothing to take it back off. I'm going to jump to the weekly chart here so you can see, here's our weekly on beans. And I want to go through the Fibonacci relationships on the down moves versus the up moves. And the reason we're doing this is because, number one, if you're in a trend, you should have some respect for Fibonacci numbers. Generally, a pullback in an uptrend or a counter trend rally in a downtrend will meet resistance at 61.8, 38.2, or 50% marks, right? And occasionally it'll go beyond that to the 78% level. So if we just think about things in terms of where is our support and resistance coming from, and is this market in an uptrend or a downtrend? Because really, for all of 22 and all of 23 so far, we've really been in a range from 1425 to 1250. Almost all of the trade action is caught right inside this middle here. So it's really difficult on a long-term basis to discern a trend. Because a trend is like what I just showed you on the 1 hour chart, where you just every bar is lower, 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 and that's where trading success usually comes from. But to really do a good job in these markets, we have to be with the primary trend, which would be the longer term one. So from the low that happened back in 2020 to the high that occurred last summer, or in the summer of 22, or late spring of 22. From this point forward, what do we have? We'll look at it. It is choppy and it is completely sloppy, right? It is overlapping, it is corrective, and it is very, very difficult to trade. If I start putting Fibonacci retracements on here, the down move from this August 23rd peak all the way down to the low here, you can see we just blew right up through the 61.8 and 38.2 retracements. So, and we ended up stalling at almost 100%. Now, the down move from earlier this year, right around January, which is where this contract peaked out, you can see we retraced more than 100% of it. So this can't be an impulsive move because it was more than fully retraced. Now, on the other hand, this move to the top side from the May 30 low unfolded in 5 waves. 1, 2, 3, 4, 5. And the retracement levels that we've had on the pullbacks have been stalling at 50. This one stalled at 50%. We know that this retracement that we had here, we know it's held at 61.8%. So the two retracements we've had from the rally that started on May 30 have both stalled at significant Fibonacci resistance, which is 61.8%. Both of these have. So that puts the benefit and the weight of all of the evidence into that this is a corrective move inside of a developing impulsive move back to the upside. And I think that this is impulsive because, look, it's not overlapping and corrective. It's straight up from the May report all the way up to 1435. This is not overlapping and it's not corrective. The pauses in here were represented more like bull flags than they did anything else. So that's an impulsive move. This move today, even though it seemed nasty and horrible, look what it did. It barely tested the 61.8. It's respecting all of its support and resistance, and it's holding its daily cloud. So where are we wrong if this is an impulsive move? Well, we're wrong. I'd like to see that this level here hold at 1633. That's why I think it's important. It's clear on the daily chart that's important, and it's clear here on the weekly. This is below our weekly cloud. It's the 61.8 retracement. It's a significant level, so we'd like to see it hold. But even all the way down to the 1280 mark, you think that's still a level that should hold, because all that level represents is so your 1250 is all the way down to the 61.8 of the move that unfolded from the May lows. And what do we know that has happened since all this information came out? Well, we know that the market's gotten tighter in supply. Now, a lot of people are saying, well, demand isn't there. It's got to be, it's going to come down. And it very well might. And in fact, it has to if the yield is below 50, because otherwise we run out of beans. So either demand has to come down, or we have a much bigger crop than anybody is thinking. And I don't think that that's the case, because the USDA keeps trimming it. So what do lower prices bring? Well, if you have a tight crop, lower prices bring more demand, which means the demand number can't get bigger, which means that our carryout is tighter, which means the lower prices aren't really right. So you have this alignment of technical tools along with the fundamental analysis that we have that suggests that higher prices are coming in the bean market. So I don't see any reason to change anything that we're doing there. Didn't like today's close at all. I mean, I'm not trying to make it sound prettier than it is, because it would have been nice to have seen it higher. But the reality is we haven't done any chart damage here, and this is still a 1-2, 1-2 count coming up out of here. And remember too, the last thing, a retracement of an impulse move in a wave 1 position, that's most common retracement is the 61.8. So you've got a 1-2, 1-2 right back into the 61.8. That's an acute risk reward. You have to take it. There's no excuse in the world not to, given the fundamentals that we know about. And if we're wrong, then we'll come in Monday and we'll be lower, and we'll have to make some adjustments and decide what to do with it. But for now, we're on top of that cloud. We should hold it. Even on the daily cloud, we're just in the top of it. I mean, we're going to come in here next week right on the top of it, ready to potentially work higher. So we'll see what happens, and hopefully we find some buying. But nobody can really explain why markets do what they do in the way that they do it. But we know ultimately supply and demand win the day. And right now we just don't see a situation where the combination of those two yields bigger carryouts, unless we have a lot weaker demand, which generally has to come from destruction. So, all right, I'm beating that horse to death. That's where we are on beans, and I think that's the move that makes the most sense. Corn is corn has just been consolidating here. The fundamentals are the weakest in corn, with the market pricing in a carryout of 2.2 billion. Again, this carryout's been the same here for quite a while. And if we have a lower move, that would tell me that the market thinks that maybe it has a larger carryout coming, maybe from a bigger crop or maybe from a lack of demand. But I don't think that's consistent with energies. I don't think it's consistent with cattle. I don't think it's consistent with the weather patterns we're seeing all over the rest of the world. And so I think that this is just harvest pressure pushing the market lower into a weekend, and we'll see what the traders want to do with it on Monday. For instance, for right now, we're holding these lows, and as long as we're holding them, then I think the bias has to remain long above it. And even if we do push down below it, we're going to deepen these divergences, and probably put us into an even more bullish situation in my opinion. And a lot of that is being driven by beans too, right? If beans get tight, corn's not going to go a lot lower. It's gonna act like support underneath the market. But you see these divergences on all of our oscillators, and I just don't see any reason why you would be a net seller of this market. You know, MACD's been diverging since July, as has stochastics. So sometimes it takes longer than you want it to materialize, but the technicals don't lie, and selling these big divergences is usually a bad idea. So we're going to sit with where we're at. You know, long 470 puts. For hedgers, we want to keep protection on there, long up above it, and we'll see what happens. Remember, the deeper corn gets, the bigger your insurance check gets from here, and it needs to come back up to 550, 570 to eradicate those insurance payouts. So history would tell us that that's a little bit more likely than not, and so we'll see what happens over the next couple of weeks. Okay, and here is wheat. Wheat was actually decently strong today. Where is my wheat chart? Here, there's September. Let's put this into December. December wheat had a nice week. It has a nice three-wave move up here so far, trying to get a wave 3 going back up above all of this support. You know, wheat did make a new low this week, and then it came back and reclaimed this low, which is significant, and it reclaimed all of this territory and chopped its way back up through here. So wheat is definitely not out of the woods. Would have liked to have seen it close above 54 today, but all in all, it had a pretty good week, and it really did a nice job. I want to show you the weekly chart here, because it looks really good in our opinion. We have a nice divergence coming all the way back to the 22 high to the July 18th 22 low. We have nice divergence action all the way through here. We have a red 13, which is bullish, and we have a spike low and a reversal bar, which is a bullish engulfing candle on the weekly chart, and climbing back up above all this support and resistance. So we need to get above 770, but that should really trigger a move back up into this area at least around 840. And you know, if this high up here gets taken out, then who knows where wheat goes. I have no idea what the fundamentals will be that drive it there. We're bullish from a fundamental standpoint because of just the world supply and demand numbers. It's getting tighter, not looser. Corn is getting tighter, not looser. Beans are getting tighter, not looser. All of these things are tightening up around us, and yet our market just continues to sell it. So something's got to break. Either the fundamentals have to shift to a more bearish stance, or our funds are wrong, and they're going to get caught in a bad situation down here, which is where we think we're headed, just given everything that we're seeing. You know, we've had some people call us and talk to us from Iowa and southern Minnesota and other states that are major producers that produce way more grain than we can in Kansas and even Nebraska, and what we're being told is we just don't have as significant of a crop as what we've had over the last couple of years. So, you know, if last year you made 280 in your corn, you're 200 or 220, or in some cases even below. So the crop is just not as big, and it's just going to take a little time for the market to absorb it and digest it. Okay, that's what we've got for you this week. We'll see where we open on Monday. I do think next week's is a really critical week for all these markets. We'd like to see them higher, no question about it. And we'll just have to see where the traders decide to take it. There is risk trading for commodity futures and options, and you should only do so in light of your own financial condition. Hope you guys have a great weekend. We will be with you Monday after the close. See you later. Have a great weekend.